Have you ever wondered how the Forex market works? The Forex market, also known as the Foreign Exchange Market, is the most liquid market globally. It's a unique, decentralized platform where you can trade one currency for another. Picture this. You're expecting the euro to appreciate in value, and you have US dollars. You swap those dollars for euros, and if you're right and the euro does appreciate, you've just made a profit. Simple, right? Born out of the 70s, the Forex market came into existence when currencies were no longer backed by gold and began to float freely. Their value, dictated by supply, demand, economic factors, and speculation. The beauty of the Forex market is its accessibility. It's a global market, open for trading 24 hours a day, 6 days a week. Now that you know what Forex is, let's dive deeper into how it operates. Did you know you can trade Forex online, right from the comfort of your home? Imagine having the flexibility to trade currencies from all over the world, anytime, anywhere. Yes, it's possible, thanks to the digital revolution. Online Forex trading is a convenient option that puts global currency markets at your fingertips. You don't need to be a Wall Street professional or a seasoned trader to get started. All you need is a computer or a smartphone, an internet connection, and a dash of enthusiasm to navigate the fascinating world of Forex. But how do you begin, you might ask? Well, the first step is to choose a reliable Forex broker. There are many brokers out there, so it's important to do your homework and select one that suits your trading style and financial goals. Brokers often require a minimum deposit, which can range from $300 to $500, depending on the broker. One of the biggest advantages of online Forex trading is the availability of demo accounts. These accounts allow you to practice trading with play money. It's a risk-free way to understand the dynamics of the Forex market, test your trading strategies, and build your confidence. Some brokers offer demo accounts that never expire, while others might have a 30-day limit. Regardless, it's a fantastic opportunity to get a feel of the market without risking real money. Another striking feature of online Forex trading is its round-the-clock availability. The Forex market operates 24 hours a day, 6 days a week, so whether you're an early bird or a night owl, you can trade at your convenience. Remember, Forex trading is not just about making quick profits, it's about understanding market trends, making informed decisions, and managing risks. It can be risky, yes, but with the right approach and mindset, it can also be a rewarding journey. With online Forex trading, the global market is at your fingertips. Imagine being able to trade 100 times your deposit. That's the power of leverage in Forex. Leverage, in the simplest terms, is the borrowed capital that enhances the potential of return in trading. It's like a loan from your broker that allows you to control larger positions than your actual deposit. This amplifies your trading potential significantly. Let's take a walk through an example. Suppose a broker offers you a leverage ratio of 100 to 1. This means that for every dollar in your account, you can trade up to $100. Now imagine you have $1,000. With the leverage, you can control a position worth $100,000. So, how does this play out? Let's say you're trading the EUR-USD pair, which is currently at 1.2500. You decide to go long, anticipating the euro will appreciate against the dollar. If the market moves in your favor by just 1 cent to 1.2600, you've essentially doubled your money to $2,000. Sounds fantastic, right? But here's the kicker. Leverage, while significantly increasing your potential profit, also magnifies your potential losses. If the market moves against you by a cent to 1.2400, you could lose all or most of your $1,000. And this can happen in a matter of minutes or hours, making Forex trading not just potentially profitable, but also highly volatile. It's important to note that leverage doesn't alter the total value of the trade, it merely changes the amount of capital you need to open a position. So while you could make larger profits, you could also end up owing more than your initial investment if the market moves against you. In essence, leverage is a powerful tool in the Forex market. It can help you achieve significant profits, but it can also lead to substantial losses. It's a double-edged sword that requires careful handling. A clear understanding of leverage and sound risk management can go a long way in ensuring successful forex trading. Leverage is a double-edged sword. It can amplify both profits and losses. Ever heard of the term technical analysis? It's a crucial part of forex trading. Technical analysis, in essence, is the study of price action. It's like the weather forecast of the financial market, where traders use historical data to predict the future. It's not about predicting the exact price, but more about understanding the potential direction of the market movement. The basis of technical analysis is that price action tends to repeat itself due to the market's collective patterned behavior. This patterned behavior is reflected in what we call chart patterns. These are formations that occur on a price chart, which traders use as visual cues to potentially predict future price movements. Now, imagine you're looking at a forex chart. It's a two-dimensional graphical representation of price over time. On the horizontal axis, you have time, and on the vertical axis, you have the price. When you connect the dots, or in this case the closing prices of each trading period, you start to see patterns forming. These patterns can be as simple as lines or as complex as head and shoulders or double tops and bottoms. But it's not just about recognizing these patterns. It's about understanding what they signify. For instance, a head and shoulders pattern often signals a market reversal, indicating that it might be time to sell. On the other hand, a double bottom might suggest that the market has reached a low point and could be about to rise, signaling a buying opportunity. Technical analysis also involves the use of technical indicators, which are mathematical calculations based on the price, volume, or open interest of a security. These indicators serve as a helpful tool to confirm what the price is telling us. Remember, while technical analysis can be incredibly useful, it's not foolproof. There is no crystal ball in trading. The market is influenced by countless factors, and even the most seasoned traders can't predict every move. But with technical analysis, you can make educated guesses and manage your risks accordingly. Mastering technical analysis can significantly improve your trading decisions. While charts tell a story, so do economic reports, news events, and political developments. Welcome to the world of fundamental analysis. Fundamental analysis is the study of various intrinsic factors that influence the value of a currency. It involves the examination of economic indicators, political moves, and societal trends to predict price movements in the forex market. It's a lot like being a detective, piecing together different clues to form a comprehensive picture of a currency's potential future. Let's break it down further. Economic indicators are statistics released by governments or private organizations that detail a country's economic performance. These can include employment rates, GDP growth, inflation, and many more. A strong economy typically makes a country's currency more attractive, leading to an increase in its value. Political conditions also play a significant role in currency valuation. Stability, policy changes, and geopolitical tensions can all significantly impact a currency's strength. For instance, a change in government can lead to shifts in economic policies, which in turn can affect currency values. Lastly, societal trends such as changes in consumer behavior and demographic shifts can influence a currency's value over the long term. For example, an aging population may lead to increased government spending on healthcare, potentially affecting a country's economic stability and, by extension, its currency value. Traders use fundamental analysis to make long-term trading decisions. While technical analysis focuses on patterns and trends in price movements, fundamental analysis seeks to understand why these movements occur. It's about understanding the bigger picture that drives market sentiment and ultimately currency values. In essence, fundamental analysis is a deep dive into the economic, social, and political factors that affect currency values. It requires a solid understanding of economic indicators and a keen eye for spotting market-moving news. But remember, while it's a powerful tool, it's not foolproof. It should be used in conjunction with other analysis methods to maximize its effectiveness. Fundamental analysis provides a broader view of currency movements, complementing technical analysis. In Forex trading, it's not just about making profits, it's also about protecting your capital. This is where the art of money management comes into play. It involves risk assessment, understanding your financial goals, and making informed decisions. The volatile nature of the Forex market can lead to significant gains, but it can also lead to substantial losses. Thus, failing to manage your money effectively can quickly drain your trading account. Risk management is a crucial aspect of money management. It's about knowing how much you're willing to lose on a single trade and setting stop-loss orders accordingly. By limiting your losses, you ensure you live to trade another day. Next, diversification. Don't put all your eggs in one currency pair. Diversify your investments across multiple currency pairs to spread the risk. Lastly, don't let emotions drive your trading decisions. Stick to your trading plan and avoid impulsive trades. Remember, in Forex trading, preservation of capital is as important as making profits.